actually there's an inverse relationship between the number of days in office and compensation, right? Compensation reduced by $14,000 per year based upon the number of days that you report in office. The people who report being in office 5 days a week versus the people who report being in office 4 days a week make less money.
We're trying to get at how close you are in compensation to your peers on the investment team. There's a lot of title inflation in business development and PE. We were asking, are you within 0 to 20% of total cash compensation to your counterpart? And then an option that you talked about, almost 43%, unclear.
Well, let's not tease them anymore. Let's get into the data and share the insights here so folks can be compensated what they're worth. What does base look like? What does bonus look like? What does total comp look like? That's why this is so important, right? Because folks actually don't have a good barometer for what compensation looks like, not just in BD, but like even inside their firm. All right, back again for another episode of Deal Sourcery with my man, Matt Rooney. Hey, buddy, how you doing?
Doing great, Dan. Happy to be back here. Happy to be chatting about our new comp survey that's coming out. I think it'll be...
Yeah, so I've got this thing on my desk right here, man. Like Coastal Partners, the official business development compensation survey for 2024. So walk me through this. Like, what's the backstory here? What are we trying to accomplish? Like, what's the genesis of this?
Well, first off, it's nice to see it in the flesh. I don't think I even printed it out myself, but old school approach, and I like it.
I'm a geriatric millennial. You know, what do you expect?
At one point, maybe we'll go physical and we'll start distributing in the snail mail or something. But yeah, I mean, this is something we do annually. This is the second time we've done it. And it's probably one of the most influential things for our business. As you can imagine, a recruiting business, knowing market compensation is table stakes to be an effective recruiter, both from advising firms but also candidates. So this information is super valuable for me and my business. And I'm happy to say that from the feedback I've gotten, it's equally as valuable for candidates that are out there, negotiating and kind of just considering opportunities. So it's great to be able to provide a resource for folks. It took a little bit longer to get the finished product together. Second iteration is a little different from the first, and hopefully some good ways. But we're going to talk about all that today.
Can't rush perfection, man. I'm sure there's a lot of value in here. So let's walk through, like, how is this all pulled together? Like, how is this gathered and what time frame? Just so everybody can kind of contextualize the data that we're going to present.
Yeah. So as you know, and as we talk about here, we do a lot of work in making sure we know everyone in the market that is in this role. And so we reach out to any and everybody that we've identified is in a BD role at a private equity firm, at a family office, at an independent sponsor, something that looks like and is set up like a private equity firm. And so our recent count is about 824 of those dedicated BD folks in the industry. And we were able to get just under 259 people participating
Holy cow.
In this year's survey, which we feel great about. Last year's was about 150. So a big jump. I think, things like,
I'm no rocket surgeon, but that's like 31%, it looks like, right? In terms of percentage of people that are dedicated BD folks that responded to the survey.
I think just time has helped. Like, I've done more work. I've led more searches in BD. I launched a podcast about BD. So, there's a lot that's contributing to people's awareness. And I think, seeing it the first time and, having it, like, I know of people who brought it to their CFO and discussed compensation packages, and I was
awesome,
really happy to hear that. So maybe it wasn't, maybe you're not the first time it's been printed out.
Dang it. I was hoping I was. But and we know that, like, just to contextualize again, these are all folks that are in business development in private equity, right? Like, not corp dev, not at public companies, not in investment banking, right? This is primarily private equity BD folks.
Yes, exactly. Yeah. So to answer your question, it's people who are in dedicated BD roles deal sourcing roles at private equity firms. And we do have to make some choices and some distinctions there. So I basically look at it as someone who would characterize themselves as fully focused on sourcing. And I say that as opposed to an investment professional at a firm that has a heavy sourcing component. These are people who they're in a career path that's distinct from the deal team. And we reached out to everyone in that type of role that we identified, asked them to participate. It was a survey that we put together that took about 5 minutes to respond to, but there was a lot of info that we were collecting. Most importantly is the base bonus carry allocations for last year and this year, or 2023 and 2024 for this survey. And but we also asked a bunch of other interesting questions that we put in the report about when the typical handoff takes place, when how often they travel, how often they're in office, remote versus in office, sharp elbowed relationships with bankers versus more of an open door policy type of thing. So a lot of stuff that I think will be really interesting to the people who hopefully tune into this.
Now, there's some interesting things just looking at the demographics of everybody that responded, right? It looked like something like 62, 63% of everybody were at lower middle market firms. Is that also a characterization of where the BD talent exists as a whole in the market? Like, is it 62% of all the 820? I mean, do we even know that? I don't know. Like, are at lower middle market funds, or like, what's your sense for? Did we get like a true accurate representation of the market based on the people that responded?
Yeah, I think so. I think that's indicative of the overall market. The kind of short headline response to that is the lower middle market has a lot of players. Let's call it, it's a broader universe of companies, a larger set of companies and targets. And as a product of that, a larger set of bankers, brokers, different centers of influence that might be in touch with those types of businesses. And so I think that lends just to a firm that's looking for companies in that space to be more likely to hire someone who's focused on sourcing. But some numbers that we pulled. So of all of the firms that have at least one dedicated business development professional, and there are 399 that we've identified, 42% of those 399 are fund sizes between 250 and just under $1 billion. So that basically connects to kind of lower middle market, mid market. Just about 50%, 45-50% are 0 to $1 billion fund sizes. So that tracks with what we're seeing in the survey.
Makes sense. And I saw, a lot of representation of the Northeast in here. I shouldn't be surprised by that, right? But like, it seemed like almost 31% of the respondents were in the Northeast. Out here in the Southwest, I mean, I'm out here on the West Coast. There's only 7% of folks out here. So, BD's all primarily Northeast still.
Yeah, for sure. I think a product of where the most private equity firms are. I don't have that data handy, but I think most people would guess New York is kind of leading the way. And so the Northeast definitely, picks up a lot of the slack. It was about a quarter of all participants were from the Northeast, or maybe a little above 30%, right? I think the rest of the distribution is pretty equal in the like major cities and the major hubs across the US. So not surprising.
Now, before we dive into the data and give everybody the insights here, there's one stat that really stood out to me on here, which was that 42.5% of folks had no idea what compensation looked like at their firms for their other team members, right? And in particular, like the question was more around, I think, like for investment professionals, like how does your comp compare to investment professionals? But it just stood out to me as like, that's why this is so important, right? Because folks actually don't have a good barometer for, like what compensation looks like, not just in BD, but like even inside their firm, right? Yep. And so it just stood out to me like, gosh, well, we got to let's dive into the data. We got to share this with folks.
Yeah. So the question was, we were trying to get at how close you are in compensation to your peers on the investment team. So if you just think of, there's a lot of title inflation in business development and PE, but if you loosely speaking, the title progression matches that of the deal team title progression. So associate, senior associate, VP, director, principal, MD, partner, depending on the firm. But we were asking, are you within 0 to 20% of total cash compensation to your counterpart, equivalent title on the deal team? And then, are you greater than 20%? And then the option that you talked about, almost 43%, unclear. So not to say that they are that far off, but I think that's probably a safe assumption is the folks that don't know probably are far off or not that close to their counterparts. And that just, it plays into something that drives my business, frankly, which is there is a ton of different approaches to compensating business development professionals out there. And this is a resource for firms thinking about it and people evaluating those roles.
Well, let's not tease them anymore. Let's get into the data and share the insights here, so folks can be compensated what they're worth, and also for folks who are hiring to know what to pay those new candidates.
So yeah, let's dive into it. So I guess the survey has a lot of information, and we're not going to go over it line by line here, but we can provide some high level takeaways that folks can just kind of digest and then dive into the survey for more granular information. But tackling it kind of piece by piece, we saw an 11% increase from 2023 base salary into 2024, and that's across all levels, seniority, fund sizes. But a healthy increase. It was a similar 11.5% increase from 23 to 24 on the bonuses. What you'll see looking in to the report is there are a lot of structures out there. So there are folks that have maybe elevated base salaries and don't receive a bonus, or there are folks that didn't receive a bonus because it's driven by success and a deal didn't close. And so we try our best to account for all of that when we're compiling this. But from a high level, there was generally a healthy increase on both the base and bonus. And if you look at total compensation, it continues to track right around 11% increase from 23 to 24.
And I found it interesting just looking at it too. Like I was wondering at first, like, does it differ vastly in terms of the amount of increase by title, right? Like, did MDs or directors or partners get more of a bump than analysts or associates necessarily did? But I think the thing that was interesting to me looking at it is it was pretty uniform, right? Across the different categories. Like, I think it was like analyst was maybe like a 9% bump. I think the highest was director principal was like a 12% bump from last year. But like on average, it was like 9%, 11%, 10%, 11%, 12%, 7%, right? And so like it was pretty consistent.
Yeah, I'd say so. And I wonder if that's just a product of kind of overall increases at private equity firms, as firms are looking at, what are our annual increases for, for deal team members and other professionals, and that kind of, nets out with the same level of increase. But there's a lot of variability in many of these roles. So it could just be also a product of the market, deals that were done or not done.
Now, to be clear, that part that I was talking about, like that variability, was primarily the base piece of the equation, right?
Sure. Yeah.
The bonus one, I don't know if you remember when we were looking at this last night. The bonus piece varies a little bit more, and that was a little bit interesting to me, right? In terms of like if you compare bonus of 24 versus bonus of 23, for analysts, it shows a 24% bump. And then for associates, it's like a 19% bump, right? And so I guess the question that was in my mind is like, maybe did we not get as many inputs last year from analysts and associates as we did this year? Or like, is there something that substantially kind of changed that, right?
Yeah. I mean, I think there's a lot of different angles that could influence it. The data set certainly could. Just the idea that an analyst and an associate with more time in the role is more likely to convert on deals. And so if they are in a role where their bonus is driven by success or some type of metric, you would expect it to go up over time, time to develop pipeline and have those turn.
Because to be clear, these numbers are people reporting they're actually received bonuses, not what they project to receive or what they could receive in the position, right?
Yeah, so there's a little bit of that because we did collect this in Q4. So I think for the most part, people had a very good line of sight into what they were going to receive if they hadn't already.
Got it.
And either that's in a discretionary bonus that historically is paid out where it's supposed to, or someone who's in a success-based type of role that has 3/4 and some change behind them and can see what's likely to finish and what their bonus will be at the end of the year.
Now, the interesting thing is it actually correlates directly with the deal volume that took place in the market between 23 and 24, right? Like if you look at the transaction volume, I was just looking at a couple different sources here, 2024 aggregate US private equity deal volume in 24 was 838 billion, representing a 19.3% increase over 2023's volume of 700 billion, right? Mm-hmm. So I don't know and that I just was thinking about that could be another driver here too, right? Of like deal volume overall was down versus like that increase. Maybe that drove part of it. Hard to say, I guess.
Yeah, it has to be a factor. And all of this nuance is, it does contribute to like a difficult process. And, you have to take all of that context into account when you're, reviewing this. And, there's not enough data points for us to separate, average bonuses based on the folks that have discretionary bonuses versus those that are in a success-based role, because you could see someone who had an extremely good year, at an associate or senior associate level with a bonus that's much higher than, a VP or director because of some type of like multiplier or something like that. And we'll talk about the percentage of the participants that had those different structures. But one thing I wanted to double click on is just the carried interest allocations. I think that's always interesting for folks that are in the role, thinking about getting into the role. Like, what does that look like? And the headline here is that VP level and above is when it starts to be much more common to have a carry allocation. So,
like how much more common? What are we talking about?
So 71%, almost 72% of the participants at the VP level have some allocation of carry. And that's compared
72% at VP or above have some carry.
So that's just at the VP level, 72% of VPs, 75% of directors and principal, and then 100% of MDs and partners that participated have some allocation of carry.
So where does that flip, right? Is that at the associate or senior associate level? Like what's that look for the kind of entry levels in the position?
Senior associate to VP. So that jump to VP is where that really flips. So we start off with analysts, 0. We had no analysts participate with any allocation of carry. Associate jumped to just under 20%. And then senior associate was just above 25%. So you go from about 26% to about 72% from that senior associate to the VP.
That's still really encouraging though, right? Like even associates, right? Like you could be a year or two into this and getting a 20 to 25% of folks in those roles are still getting carry.
Yeah. Again, I think it's case by case basis, right? I think the firm and, their kind of philosophy on that and, where they are, that we talked about maybe offline, like a lower base salary, might imply a greater or more likelihood of carry, right? You kind of can make up for it in that, in some ways. But I think it's promising to see that high of a frequency of carry allocation at the VP level, because anecdotally, a lot of the VP searches that we run, these like first time BD hires, there's a good amount of hesitancy from firms in in having that be part of the package. And there's a difference if it's part of the package from day one and, advertised in the compensation package versus a year down the road. And we see a bit of that too. But I think to be competitive with, successful BD professional at the VP level and above, it's important to have that as part of the package.
Do we know how that's changed? Like, did we look at last year, the carry breakdown, like what percentage of folks had carry in 23 versus folks that had carry this year?
No. Yeah.
No.
I don't have that.
All right, we'll have it for next year, right? We'll have it for next year.
Yeah. Yeah. Yep.
And then, but then to round this out, right? When you look at these components again of base, of bonus, of carry, right? Can you give just the high level, like what's the average, both base, bonus, and maybe we just put it in two buckets, right? Like what's the base and what's the on target earnings, or what's the base and total comp for these different positions, so that folks kind of have we give them the rundown of like what that's looking like by position for this year.
For 2024, so analyst level, we'll just go base, bonus, and total comp. So average base just under 87,000, the bonus at 35,000, and the average total comp for analysts at 122,000.
Okay.
Associates 110,000 or almost 111,000 base. The bonus is just above 55,000, and that puts us at an average of 166,000 for associates.
Okay.
Total comp. Senior associate, we jump up to pretty significantly. Average base goes from 111 as an associate to just under 150 for the base salary. The bonus is 91,000, and then the total comp is 237, just under 237 for a senior associate. So pretty significant jumps. And then I think the same thing for VP. So the average base was 200. The average bonus is 140. And then the average total cash is 336. And then we group together directors and principals. The average base is just over 231,000. The average bonus is just under 160,000, and the average total cash comp is just over 390,000. And then to wrap up here, we put together MDs and partners, and that average base is 367. The average bonus is just under 350. And that brings the average total comp to just over 700,000. So a lay of the land, for what folks can expect. We fortunately have enough data this year that we were able to break that down by title and fund size, which I think is the real kind of meat of the survey here. So people can get a little more granular on, their fund size. And we, of course, see compensation increase across fund size. So it's important to suss that out.
Yep. So again, we're starting basically average at the analyst position, starting at the 87,000-ish range up to MD partner level, 370-ish range. So kind of like, again, like 87 to 370 is kind of the base range for folks across the profession. And then the bonuses obviously vary widely, but like from an average of analysts around 35 grand per year to, partners, MDs in the 350-ish range for bonus. So then net a range of total comp between 120 to about 700,000 in cash comp.
Of cash comp. Yep, exactly.
Got it. The interesting thing, to your point on doing the breakdown by fund maturity and size, like, I mean, I'm a sucker for numbers, right? And kind of figuring out formulaic and approaches to these things. So I ended up running a regression analysis on this on everything last night, and it was interesting, right? Like there's kind of a formula here that started to come together when you piece these things, different components to it, right? Like looking at what's their position, what's the fund that they're at, what's the fund size that they're at. A lot of these different attributes that kind of added up to, how do you via a formula, like solve for like what this person's compensation should be. Not that I'm trying to put us all in a box and say like we all belong in a formula or whatever, but it was interesting to me to look at the fact that the biggest, so I ran a couple different regression analyses here, did a multivariate regression analysis. I did it with just a couple, isolated a couple different factors. And I found that base salary in particular, that seniority level of base describes 95.2% of the variability, right? So like what I did is I said, like, you've got analyst, associate, senior associate, VP, director, like each one of those is a level, right? And that the just changing of that title describes 95% of the base compensation, which I think makes sense.
Yeah.
Right?
Yeah.
Like you get a new title, you're like your title is a primary driver, not of your bonus, but of your base.
Oh, yeah, totally makes sense. I think you expect compensation increases, base increases at title promotion. So that checks out.
And so the formula, and so when I looked at that, what I started doing is, all right, let's take seniority level and let's look at like what other attributes we add on there significantly influence the total the base compensation number and the total compensation number. And so starting with just that title, the title actually explains the majority of it. You actually had an R squared of 0.557 when I looked at base salary. When I look for base salary, how do you describe it? By the title as well as the fund size. Those two things basically describe the majority of compensation, right? It's kind of those two things. But the biggest chunk of that is truly just that whatever your title is. But the second behind that was fund size, right? But it didn't describe a ton, right? It was, I think, order of magnitude like 3 to 5% of it was kind of described by fund size. And I ran this a couple different ways. It looked like basically you take a multiple of the fund size in millions and you multiply it by about 10. That seems to be and then add that on with your seniority level. So basically it's like 49,000 per level, right? And again, it's not totally accurate because like if you look at base salary is 86,000, right? Basically for every bump you add close to another like 45 to 50,000 for every level that you add on top of that. And then one of the other big drivers was, well, if you lead the BD function, that seemed to be like a 50K bump if you purely lead the BD function. And then when I pieced the rest of it together, and sorry, I'm kind of going off the rails here a little bit, just walking through all the different pieces that I tried to explain how I looked at it. But when I did kind of the multivariate linear regression on this, right, I looked at seniority level, fund size, fund type, if they lead the function. And then the other interesting one that seemed to have a strong correlation was number of days in office.
Yeah, that's interesting. I saw you add that to the docket. Say more about what that tells you.
Yeah. So, okay. So not only did like whatever your title is inform what your compensation is and the fund size and whatever, but actually there's an inverse relationship between the number of days in office and compensation, right? And what I was finding is compensation reduced by $14,000 per year based upon the number of days that you report in office, right? So the people who report being in office 5 days a week versus the people who report being in office 4 days a week make less money.
That's really surprising.
I'm sitting here going, well, gosh, is this not just supporting the argument of, get on the road and get in front of people? Because like, it's clearly in the data, the folks that are just sitting in the office every day are making less money than the ones that are actually out there hitting the road and getting in front of people.
Yeah, that's really interesting. I wouldn't have predicted that to be a factor. And even anecdotally, like, sure, like there are people I speak to that I know do really well, and they have a heavy approach to travel. But that's really interesting to see that actually exists in the data.
Now, the interesting piece would be to know, like, is that, because I'm hypothesizing, right? Like, I'm hypothesizing that that's a result of people getting on the road, and like the people that get on the road get paid more because, they close more deals. Again, this is out of total compensation, right? So like effectively leading it in part to bonus out of this. There's another explanation though that could be people that work remotely primarily or more often as opposed to going into the office are compensated more.
Not to throw like a wrench in the reliability of the data, but you look at like some of the responses here. There's a question: are you remote? Yes, no. And then there's a question: how many days a week in the office are you? And some of the people who marked yes to remote also marked a number of days in office per week. So maybe you have a theory on what was intended by that. But I think the theory is still interesting, and there might also be a factor of, as I look at the people who are remote, there's few firms out there that like prioritize or hire remote. There are more remote business development professionals that either became remote through COVID or through some sort of kind of like grandfathered in type of situation, or just demonstration that they do their job well and they needed to move, and that was okay. You might have some selection bias of those top performers getting that ability to be remote, versus an indication that they travel more. But that's just trading a theory for a theory.
For sure. And so lots of potential theories here, lots of ways that this could add up to something, meaningful here. Again, back to the big one that seemed to really stick out here is that like seniority level seems to be the primary indicator of like the most significant change in base compensation. And then fund size kind of behind that. Then there's a handful of other potential predictors to it. But effectively, if you take seniority level times $50,000, that usually gets you kind of your base. And then if you take fund size in millions and multiply that by approximately 10, that kind of gets you the balance of the base compensation. And then I think obviously the rest of it is explained by a lot of other factors, but there's clearly some variability by firm type, by firm size, by fund maturity, like fund number that you're at. If you lead the function, and then like number of days in office. Can we spend a minute to jump into the bonus side of the equation, like the mix between, because I think last year we talked a bit about discretionary stuff versus metric driven compensation for bonus. Like, give me a rundown. Like, what are we seeing? How are people being compensated as it relates to their bonuses?
Bonus structure is a big topic. So it's something that comes up all the time, both from firms that are thinking about, how to structure, incentivize folks, and people who are evaluating opportunities. So it's one of the more important things that we collect in here. Last year we saw in the report that 62% of the participants had discretionary only bonuses. So similar to kind of the typical structure for a deal team member, you have kind of like a target at the beginning of the year. It's a percentage maybe of base salary or a range, and that might be influenced by how the firm did, how you did, but largely guaranteed or the high expectation that it's guaranteed, and also just dependent on your superiors. We see a similar amount this year. So we jumped up 100 participants, and we're seeing 57% indicate that they only receive discretionary bonuses. And so, the big picture, we're comparing discretionary bonuses to success-based bonuses, i.e., deal closing, or some firms that have it driven by number of LOIs submitted, or different stages that have different levels of bonuses,
like meetings booked or IOIs or
And so if we bucket together success-driven bonuses and metric-driven bonuses, that is just 12.5% of the participant pool that has solely success and metric-driven bonuses,
really?
No discretionary. Yeah,
so only 12% of folks are truly measured on the product, metric based, or how are you drawing that distinction, success or metric? Like, what's the distinction for you?
So meetings booked I would put that in the category of metric driven. So if you're, if you're supposed to, like, say you have a target for number of quality conversations, you're supposed to set up with targets, over a quarter or a month. And your consistency in hitting that target over time influences a certain bonus. And the tricky thing, like a lot of the things we're talking about here, is there isn't one uniform way to do any single part of what we're talking about here.
Sure.
So like even discretionary, it's not to say that those people aren't being evaluated on metrics. Like discretionary bonuses, I'm sure in most cases, the folks who are looking at performance are evaluating number of deals seen, number of deals.
Right, but it's less formulaic, right? It's just kind of like, yeah, I think you deserve $20,000 this year.
Yeah, yes, it's very different than here's your employee handbook and here's an outline of how your compensation works, and this is how much money you make when this happens. So yeah, it's I think because of the complexity of those structures and the high upside, I think that probably like holds more weight from like an anecdotal perspective and is talked about more. But it's only, in this survey we're showing it's only 12.5% of people that are solely based on that. It does leave about 30% that have discretionary bonuses and some success or metric driven bonuses as a mix. So that is a good chunk of the folks that are out there in the market.
But it looks like it's moving that way, right? Because if I'm looking at the numbers, right, we had discretionary only last year was 62%. Now discretionary only is 57%, right? Now, given like there's probably margin of error there of, what is that, 5%? But a high level that like seems we're moving in the direction of more, I guess, success or metric based compensation, even though it's still only 30 some percent of folks that have metrics or success as part of their bonus process.
Yeah. I mean, I'm excited to see what like next year's survey tells us, right? Like I don't feel like I'm seeing that in my experience necessarily. Like more firms are
so it feels about the same to you, is your point?
It feels about the same. It feels discretionary is by and large the most common bonus structure in the folks that I interact with. We've had discussions about this before. Like, you come from an environment where like if you do the job, like you can really get rewarded for it. And I see that, I see like why like, real high performers would be like interested in that type of environment. But I also see, how, we're at the tip of the spear, the BD function, the sourcing function, right? And there's so much that happens after you do the job that is out of your control. And to have your whole compensation reliant on that, I get why people hesitate to jump into that. So, my kind of, I guess, conclusion or what I would recommend is what we see 30% of folks already have, which is a combination of the two. If you can figure out a way to, make people feel incentivized, have some sort of accountability in metrics or something that you're tracking, and also feel like they're getting upside when they deliver on something that is really meaningful for the firm. And carried allocation, carried interest also serves as a tool, pointing in the same direction, right? This is, long-term compensation that, is incentivizing someone to do a good job, get deals done, get good deals done. But we see, BD roles in particular have this kind of extra flair where you can maybe sub in something on the bonus side to account for that.
Yeah, I'd just say if I'm placing bets, it's going to go more and more the direction of like metric and success based, because at the end of the day, like as a private equity firm, you can't eat, NDAs signed and IOIs and LOIs. Like the only thing that matters is that we actually close deals, right? And like you need to drive everybody toward that metric. And as you see across, sales and marketing best practices, like you measure, you get what you measure, right? And so like measure that you're getting to the end of the funnel, not that like I drove a bunch of meetings, right? Because like if I'm measured on meetings, sure, I'll just pile in a bunch of meetings so that I've got those meetings. And like, if that's all I'm getting comped on, then you're going to get a bunch of bogus meetings. I don't care, but I hit my meetings number. So like, who cares, right? So to me, like from a firm perspective, you got to measure that end result if you're going to measure something. And again, the reason I'm betting on this is like, as the proliferation of private capital continues to increase, I mean, we're at a 15.5% CAGR over the last decade in terms of AUM, right? You're going to have more and more push from private equity firms to say, we've got to make sure we're actually deploying capital, not just giving people bonuses, because they did some of the other things that are up funnel.
This leads to another point. I would bet that the 12.5% that are solely success and metric driven bonuses, I would bet that the vast majority of those people are in proprietary focused sourcing roles. Sure. I think what we're saying is very dependent on the context of the firm and their investment strategy and where they're looking. And you see it more often. The firms that prioritize proprietary sourcing, that build teams around that effort, they are more likely to have these types of structures. And just on that note, 45% of the respondents in the survey say that they spend 70% of more of their time, so the bulk of their time, covering intermediaries. 27% spend the bulk of their time on proprietary. So it is, net of the, I think this is representative of the market, of the, 825 total people out there. I think half, or the majority, probably close to it, are mostly intermediary coverage. And you could loop in kind of other PE firms. There were ways that we kind of offered more options to get more granularity, but the bulk of folks in this role are doing intermediary coverage, and proprietary is still a small but growing piece of the puzzle.
Just looking at that, right? Like, do we have a sense year over year in terms of the change in focus on folks saying, hey, I primarily focus on covering bankers versus doing direct outreach? Has that changed from last year to this year?
Yeah. So last year it's similar. So I think actually you'll see a slight increase in the proprietary side of things. So last year it was about it was like around 20% of people that were mostly focused on proprietary. And I think we're somewhere in the kind of 45-50% that were focused on intermediary for the most part. And a good chunk, a little over a quarter of the participants last year that were 50-50. So I think you do see at least a slight increase in the number of proprietary focused folks. And I wonder if that'll continue to be the case.
So look, lot of great information for us in here in this report, in the survey, both around, compensation, where people are spending time, the priorities, awesome stuff around like BD and the where sourcing is going. If folks want to dive deeper into this, learn more about it, view the full report, where should they go?
Yeah, I think our Coastal's website, I think coastalpartners.co is a good place. We'll have this up there at some point in the near future for folks to download. And then I think for you and I both, our LinkedIn is kind of the focal point for info that we talk about, the topics that we talk about on the show here. So I'd direct people to my page and yours, and keep up with the Deal Sourcery pod. And, we'll keep putting out stuff like this.
There you go, folks. A treasure trove of information around BD sourcing, BD compensation. Subscribe to the Deal Sourcery podcast. Thanks for joining us. We'll see you next time.